Gold just crashed 21% in a single day, then bounced back above $5,000. Now it's sitting at $4,978 as 280 million Americans wait for one number. The January inflation report drops in 4 hours, and what happens next could decide whether gold hits $6,000 or collapses to $4,400. Most people have no idea what's actually happening. Welcome to Capital Anchor. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, subscribe right now because what I am about to show you could change how you see the entire precious metals market. Let's talk about what just happened. Gold hit an all-time record of $5,600 per ounce on January 28, 2026. 2 days later, it crashed to $4,403. That's a 21% drop in one trading session. Silver fell 40% in the same period. This was the worst single-day collapse for gold since 2013. The worst silver crash since 1980. Over $200 billion in paper wealth vanished in hours. Then something strange happened. Gold bounced. It recovered to $5,070 by February 11th, then pulled back to $4,978 as of this morning, February 13th. Right now, as you watch this, gold is consolidating between $4,996 and $5,107. Traders are frozen, retail investors are panicking, and the U.S. Consumer Price Index report for January releases at 8:30 a.m. Eastern today. Economists expect headline CPI to rise 0.3% month-over-month. Core CPI is forecast at 0.3%. Year-over-year inflation is projected at 2.5%, down slightly from December's 2.7%. Here is what most people do not understand. This is not just another inflation report. This is the first major economic data release since gold's historic crash, and it will determine whether the Federal Reserve cuts rates this year or keeps them elevated. The market is pricing in a 95% probability that the Fed holds rates steady at its January meeting, but the bigger question is March and June. If inflation comes in hot today, rate cuts disappear. If it comes in cool, gold rallies. Here is the mechanism nobody is explaining to you. Think of gold like a seesaw. On one side sits the US dollar, on the other side sits gold. When the dollar weakens, gold rises. When the dollar strengthens, gold falls. Now add interest rates to the picture. Higher interest rates make the dollar more attractive. Money flows into US Treasury bonds. Gold, which pays no yield, becomes less appealing. So gold falls, lower interest rates do the opposite. The dollar weakens, Treasury yields drop, investors flee to gold as a safe haven. Gold rises. This is why today's CPI report matters so much. If inflation is higher than expected, the Fed has no choice but to keep rates elevated, maybe even longer than markets currently expect. That strengthens the dollar, and gold gets crushed. If inflation is lower than expected, the Fed has room to cut rates. Markets will immediately start pricing in June or July rate cuts. The dollar weakens, and gold surges. But here is where it gets interesting. There are 3 reasons gold crashed in late January, and none of them had anything to do with fundamentals. Reason number 1, Kevin Warsh. On January 30th, President Trump nominated Kevin Warsh to replace Jerome Powell as Federal Reserve Chair when Powell's term ends in May. Warsh is a known monetary policy hawk. He favors higher interest rates to control inflation. The market reacted instantly. If Warsh takes over, rate cuts are off the table, maybe for the entire year. Gold crashed 9% in a single trading session. That was the trigger. Reason number 2, speculative unwind. Gold had gone parabolic, from $4,000 in early January to $5,600 by January 28. That's a 40% gain in less than a month. Silver had jumped from $65 to $121, a 86% gain. This was not organic demand. This was leverage. Retail traders piled into gold and silver futures. Hedge funds went all in. When the Warsh news hit, leveraged positions got liquidated. Margin calls cascaded. Futures contracts got dumped. Trading exchanges raised margin requirements that forced more selling. The sell-off fed on itself. This is what analysts call a positioning reset. It was violent, but it was not structural. Reason number 3. China selling rumors. U.S. Treasury Secretary Scott Bessent publicly blamed unruly trading in China for the volatility. He suggested Chinese speculators were driving the price action. Markets interpreted this as potential Chinese selling. But here is what the data actually shows. China's central bank, the People's Bank of China, bought gold for the 15th consecutive month in January. They added 40,000 troy ounces. Their total holdings now sit at 74.19 million troy ounces, worth $369.58 billion. They did not sell. They bought through the entire crash. While retail investors panicked, the BOC quietly accumulated. This is the disconnect nobody is talking about. While you were watching gold crash on your screen, the world's second-largest economy was loading up, while financial media was calling this the end of the gold bull run. China was stacking reserves. This is the big player versus retail pattern. Retail investors trade on emotion. They see red candles and panic. They sell at the bottom. Institutions and central banks trade on strategy. They see dips and buy. They accumulate when prices fall. China is not alone. Central banks globally purchased 863 tons of gold in 2025. That is the second highest annual total on record. Global gold demand in 2025 hit 5,002 tons. The first time in history demand exceeded 5,000 tons. Total value surged 45% to $555 billion. Let me repeat that. Central banks bought more gold last year than almost any year in history, and they are still buying. But the mainstream narrative is telling you gold is over. The rally is done. Time to sell. This is the moment where wealth transfers, from the uninformed to the informed, from the emotional to the strategic. Most retail investors sold gold between $4,400 and $4,800 in early February. They locked in losses. They got shaken out. Meanwhile, gold-backed ETFs posted inflows on January 30th, the worst day of the crash. Professional money was buying. Dip buyers stepped in at $4,500. Institutional demand absorbed the selling pressure. Gold stabilized. Now here is what happens today. The CPI report releases at 8:30 a.m. Eastern. Gold will react immediately. If inflation comes in above 0.3% month over month, expect gold to test support at $4,900, maybe lower. If it breaks below $4,800, we could see a retest of $4,600. If inflation comes in below expectations, gold will likely break above $5,100 within hours. That opens the door to $5,250, maybe $5,400 by next week. The technical setup is coiled. Volatility is guaranteed. But here is the critical piece most analysts are missing. The CPI number itself is almost irrelevant to the long-term thesis, because three structural factors have not changed. Let me show you why none of this changes the bigger picture. Go back to March 2020. Gold was trading at $1,580. COVID hit. The Fed slashed rates to zero, printed $4 trillion. Gold surged to $2,067 by August 2020. Then something unexpected happened. The Fed started hiking rates in March 2022, from 0% to 5.5%. Everyone said gold was finished. Higher rates mean stronger dollar. Stronger dollar means gold crashes. That was the narrative. But gold did not crash. It consolidated between $1,800 and $2,100 for 2 years, then broke out to $2,900 in late 2024, then $4,000 in January 2026, then $5,600 at the peak. Gold rallied through the entire rate hike cycle. Why? Because central banks were buying, because de-dollarization accelerated, because physical demand from Asia overwhelmed paper selling in the West. The fundamentals overpowered the technicals. History is repeating right now. Gold crashed from $5,600 to $4,403 in late January. That's the technical correction. But the fundamental drivers remain intact. Let me show you what has not changed. Fundamental number 1. Central bank buying. The People's Bank of China bought gold for 15 consecutive months through January 2026. Total official reserves now sit at 74.19 million troy ounces. But here is what most people miss. China's actual holdings are likely far higher. They route purchases through state-owned commercial banks. They buy through Hong Kong exchanges. They accumulate off the official books. Analysts estimate China holds 3,000 to 4,000 tons more than reported. Russia holds 2,336 tons. India holds 854 tons. Turkey, Poland, Singapore, Czech Republic all adding to reserves. This is not a short-term trade. This is a 10-year repositioning away from dollar dominance. Fundamental number 2. De-dollarization momentum. Global central bank dollar reserves fell to 58.4% of total reserves in Q for 2024, down from 73% in 2001. This trend accelerated after US sanctions on Russia in 2022. Countries are diversifying into gold, into euros, into yuan. The BRICS nations are building alternative payment systems. They are settling trade in local currencies. Gold is the neutral reserve asset. It has no counterparty risk, no sanctions risk. The US dollar share of global reserves fell from 59% to 58.4% in 1 year. That sounds small, but it represents $380 billion shifted out of dollars. Where did it go? Gold, bonds from other nations, physical assets. Fundamental number 3. Physical market tightness. COMEX gold inventories dropped 18% in January. Eligible gold stocks fell to 8.2 million ounces. That is enough to cover just 14 days of average trading volume. The London Bullion Market Association reported net outflows of 347 tons in Q for 2024. Physical gold is leaving Western vaults. It is flowing east, to Shanghai, to Hong Kong, to Dubai. This creates a structural bid under prices. When paper markets crash, physical buyers step in. That is why gold bounced from $4,403 to $5,070 in just 10 days. Physical demand absorbed the selling. Fundamental number 4. Geopolitical risk premium. US-China tensions remain elevated. Tariff threats continue. The Middle East is unstable. Ukraine conflict persists. These risks do not disappear because gold corrected 21%. Gold is the ultimate geopolitical hedge. When uncertainty rises, gold demand rises. That premium is now embedded in pricing. It was not priced in at $2,000. It is priced in at $5,000. Now here is my on-the-record prediction. Screenshot this. Gold will retest $5,400 by March 15, 2026. That is 30 days from today. The consolidation between $4,900 and $5,100 is building energy for the next leg higher. Why March 15th? Because the Federal Reserve meets on March 18th to 19th. If inflation continues to cool over the next 6 weeks, rate cut expectations will build. The dollar will weaken. Gold will surge ahead of that meeting. But that is not the only path forward. Let me give you 3 scenarios with probabilities. Scenario 1. Inflation stays sticky between 2.4% and 2.7% for the next 3 months. The Fed keeps rates on hold through mid-2026. Gold consolidates between $4,800 and $5,300. Probability, 55%. This is the base case. Gold does not crash, but it does not moon either. It trades in a range. Accumulation continues. The next major breakout comes in late 2026 when rate cuts finally materialize. Scenario 2. Inflation surprises to the downside, falls below 2% by April. The Fed signals rate cuts in June. Gold breaks above $5,600 and targets $6,000 by summer 2026. Probability, 30%. This is the bull case. Lower inflation forces the Fed's hand. Markets price in multiple rate cuts. The dollar weakens sharply. Gold surges. Central banks accelerate purchases. We see $6,000 before August. Scenario 3. Inflation re-accelerates above 3%. The Fed is forced to hike rates again or keep them elevated through 2027. Gold retests $4,400 and potentially breaks lower to $4,000. Probability, 15%. This is the bear case. But even in this scenario, gold does not collapse below $4,000. Physical demand provides a floor. Central banks buy the dip. The long-term trend remains intact. Now let me give you practical takeaways based on who you are. If you are holding physical gold or silver, do nothing. The crash in late January was a leveraged futures market event. It did not impact physical supply. your metal is worth exactly what it was at $5,600. Physical holders should use any dip below $4,900 as an opportunity to add dollar cost average by small amounts consistently. This consolidation is your gift. The market is giving you a second chance at prices below $5,000. If you are trading gold futures or using leverage, reduce your position size immediately. The volatility over the next 4 hours will be extreme. If you got margin called in late January, this is your warning. Leverage kills in volatile markets. Active traders should wait for the CPI release at 8:30 a.m. Eastern. Let the market digest the data, wait for a clear direction, then trade the breakout. Do not try to predict, react to price action. If you are sitting on cash on the sidelines, today is decision day. If gold breaks below $4,900 after the CPI report, that is your entry. Set alerts, be ready to buy. If gold surges above $5,100, wait for a pullback to $5,000 before entering. Cash holders have the luxury of patience, but do not wait forever. Every month you delay, central banks are buying. Physical premiums are rising. The best entry was January 30th at $4,403. The second best entry is today. If you bought gold at the top between $5,400 and $5,600, you are underwater. This is painful, but zoom out. Gold was at $2,000 just 14 months ago. You are still up massively if you bought before 2025. For those who entered at the peak, your only move is to hold. Selling now locks in losses. Gold will retest $5,600. It might take 3 months. It might take 6 months. But the trend is intact. Now here is what you need to watch going forward. Indicator number 1. The US dollar index, currently at 107.5. If DXY breaks above 109, gold will struggle. If DXY falls below 106, gold rallies hard. Watch this daily. Indicator number 2. COMEX gold inventories, released weekly every Friday. If eligible stocks drop below 8 million ounces, physical tightness will drive premiums higher. This supports prices. Indicator number 3. China's official gold reserves, released monthly by the BOC. If they stop buying, that is a red flag. If they accelerate purchases, that confirms the bullish thesis. January showed 15 straight months of buying. Watch February's data in early March. Indicator number 4. Federal Reserve. Plot. The Fed updates rate projections at each meeting. If they signal no cuts in 2026, gold will consolidate longer. If they signal to -3 cuts, gold explodes higher. Next update comes March 19th. Let me tell you about 3 types of people watching this video right now. The first type is panicking. They sold gold between $4,400 and $4,800. They are checking the price every 5 minutes. They are hoping it crashes lower so they feel better about selling. The second type is frozen. They bought at $5,500. They are down 10%. They do not know whether to sell and cut losses or hold and hope. They are paralyzed by fear and regret. The third type is learning and preparing. They understand that volatility creates opportunity. They know central banks are buying. They recognize the long-term thesis has not changed. They are setting alerts, planning entries, staying calm. Which type are you? Because markets do not care about your emotions. Markets reward preparation. Markets transfer wealth from the impatient to the patient, from the fearful to the informed. The crash in late January was not a black swan. It was a gift, a chance to buy gold below $4,500. Most people missed it because they were paralyzed. The next dip will come, maybe today after the CPI report, maybe in 2 weeks. Will you be ready? Remember what I said at the start. Gold crashed 21% in one day, then bounced back. Now 280 million Americans are waiting for one inflation number. That number will determine the next move, but it will not determine the long-term direction. The long-term direction is set by central banks, by de-dollarization, by geopolitical risk, by physical demand. Those forces are intact, stronger than ever. The January crash was noise. The signal is clear. Here is what I want you to do right now. Hit that like button if you found value in this breakdown. Subscribe if you want to understand what is actually happening in markets. Share this video with someone who is panicking about gold right now. they need to see this. And drop this exact phrase in the comments. I'm watching the indicators. Tell me which indicator matters most to you, the DXY. COMEX inventories? Central bank buying? I read every comment. Let me know. The wealth transfer is happening, right now. The question is which side you are on.